Well, the trick is, of course, I mean, I'm not Warren Buffett. Okay, I haven't abandoned the value cult and gone looking for wonderful businesses. What we're looking for are mundane businesses that are not afforded an enormous multiple, particularly a free cash flow yield. We look at enterprise value, very important metric, but where the opportunity exists, but it's not perceived. And so that may be involved in a long lead time. So we're not looking particularly for wonderful companies. We're looking for companies that could become wonderful for one reason or another. Otherwise, we wind up overpaying. And what overpaying is it's a complicated issue for somebody who is not a deep value guy. And I know people who are deep value guys, or even people who are, I would argue, more in my camp of being catalytic type special situation buyers. Some of them have gone through this entire bull market with more than 50% cash because of the, I would say, the orthodoxy of their views in terms of the metrics and whether they consider that to be value. I've always felt that you've got to adjust what you're going to pay for a company on the basis of what the alternative is, which is fixed income, and that, of course, is determined by yields, government yields. And so, in the current situation, where the government has gotten to a point where they've pushed interest rates to a level that people have no choice but to buy stock, I may be willing to, pay a little more for a company, say an industrial company. When I got into business, most industrial companies were trading between 3 and 6 times EV to EBITDA. Then there was a lot of consolidation, and they began to trade maybe between 5 and 7, because obviously if they survived, they had something going for them. And then, of course, in this world of globalization, maybe their opportunities expanded. And finally, when interest rates got pushed down, a lot of these companies, went to 10 or 13 times EV to EBITDA. So at some point in there, I said, enough's enough, maybe between 8 and 9, and then you have to sell, and you have to really sell and get out. Otherwise, you're no longer a value guy. You've wandered into the GARP arena or something, whatever Buffett's in. But finding that tension point about where you want to sell is more of an art than a science. I mean, you can, and again, we scale out just like we scale in. So it's a dynamic process.